it's going to be a little bit like the pandemic on steroids, where they're going to be faced with a free-falling financial system around the world. And I think you're going to see around the world that response, that we got to do big money, which will be the first thing because it can do that quickly.
You're watching Silver News Daily. Subscribe for more.
Imagine waking up to find silver prices have skyrocketed to $500. Sounds impossible, right? But legendary market strategist David Hunter says, this is not just a wild dream. It's closer than you think. What's driving this unprecedented surge? And more importantly, how can you prepare? Let's break it all down, and trust me, you'll want to stick around for this.
I've been saying for 2 years that we'd be in this melt-up and that the last stage would go parabolic. And I think we saw that week of the election after Trump won that it did move up pretty aggressively. We're up 5% on the week, I think. So I think that is the beginning of the parabolic. Doesn't mean it's going to go up every day or even every week, but it's going to be a steeper part of the rally. I think we've been in the melt-up for the past year, and looks like it's proceeding as scheduled. I have a target on the S&P now of 7,500. It's probably up from when we last talked, and 25,000 target for the NASDAQ. And Dow, my target is 55,000. The Russell, which has been the laggard, is now catching up. It looks like it's taking the lead, which is what I had predicted, that we would see a broadening of the market into the small caps. We're now approaching, if we haven't already touched the new highs on the Russell, going back to late 2021. So it's been the one market that had lagged, and now it's starting to kick into gear. I have a target on the Russell and have had all year of 3,300. I think, if anything, that's going to prove low. So, if you calculate those targets, basically I'm calling for 25 to 40% upside from here. So we're in the last stage, but that last stage I think is going to be basically parabolic. So things are in pretty much along schedule as far as I can see. I think the bond market, which has corrected pretty aggressively since the September rate hike, is now looking like it's finally finished that correction. Backed up. It had come down from the 10-year had come down from 5% down to 360, and backed up to 450 in the last couple months. And now looks like it's rolling back over, and I expect to see the 10-year down below 3% in the next few months, and ultimately later on, with a much weaker economy, could go down to zero. So that's not a misstatement. I think we could see a 0% 10-year sometime later next year, probably last quarter of next year. And the dollar, which again has been in a counter trend consolidation or correction for quite some time now, that looks like it's finally rolled over, and I think you're going to see that. Once it gets down below 100, it got up to 107, I think, maybe a little higher. Once it gets down below par, down below 100, I think you'll see it start speeding up on the downside. So, everything's pretty much in gear as I see it. Weak dollar, lower rates. Fed, in spite of people worrying about inflation, the Fed is still, I think, in the beginnings of an easing cycle that will continue through next year.
As we dive deeper, let's take a closer look at where the silver market stands today. Currently, silver prices hover around $1.25 per ounce, but what's striking is the underlying momentum building beneath the surface. Over the past year, we've seen increased volatility driven by global inflationary pressures and a renewed interest in precious metals as a hedge against economic uncertainty. The Federal Reserve's aggressive interest rate hikes have grabbed headlines, but while these moves initially strengthened the dollar and suppressed precious metals, the tides are starting to turn. Inflation remains persistent, eroding purchasing power and forcing investors to reconsider their strategies. This has created a renewed focus on tangible assets like silver, which offers not just stability, but also significant upside potential. Adding fuel to the fire is silver's unique dual role in both the industrial and investment sectors. Industrial demand is surging thanks to silver's indispensable role in green technologies, particularly solar panels and electric vehicle production. At the same time, traditional investors are increasingly turning to silver as a safe haven amidst fears of a looming recession and geopolitical instability. Furthermore, the supply side tells an intriguing story. Major silver-producing nations, such as Mexico and Peru, have reported fluctuations in mining output due to regulatory challenges and environmental concerns. This supply constraint is creating a perfect storm for higher prices as demand continues to outpace production. Another factor worth noting is the subtle but consistent shift in sentiment among institutional investors. Hedge funds and asset managers are quietly accumulating silver-backed assets, signaling a potential shift toward a more bullish stance on the metal. Right now, the market is at an inflection point. Analysts are watching closely as the dollar shows signs of weakening, which historically has been a major catalyst for silver's upward trajectory. With central banks around the world increasing their gold and silver reserves, many see this as a vote of no confidence in fiat currencies and a signal that precious metals are poised for a breakout. The question isn't just whether silver will rise, it's how quickly and by how much. Are we witnessing the early stages of a historic price surge, or is this just the calm before the storm? One thing is clear, the conditions are ripe for something extraordinary, and silver is positioned to play a leading role in the story.
Yep. No matter what their best intentions are, I think we are going to see massive stimulus. And initially, it'll be massive effort to keep a financial system from breaking. It'll be basically in a tailspin that they have to first stabilize, then get turned the other way. But with a lag, that will lead to, I think, a recovery cycle that I think this is where his policies kick in, will be an industrial-driven cycle, unlike what we've had for the last 4 decades, which has been, consumer-driven, service-driven. We're going to be seeing a lot of reshoring. We're going to be seeing, basically the need for commodities, et cetera, to, you're building factories, you're building your industry back up. And I think that leads to a commodity cycle because of the demand for commodities. And what we run into is that we've spent many decades kind of moving away from that capital-intensive, commodity-intensive business. And the commodity companies have been rationalized down. Their capacity has been rationalized down to meet the new demands of the last many decades. Now, all of a sudden, because of the macro, the big pumping of money and fiscal increases, and because of the policy moving back towards reshoring, that's all going to force demand for commodities through the roof. And you're going to have limited capacity because capacity has been rationalized down. And then you're going to have this big boost in demand. And so you're going to have demand far outstripping capacity. And of course, in commodities, it takes years to develop new capacity, sometimes a decade. So you're going to have a situation where the only thing that can give is price. And that's why I think you can get very high inflation is, you can have demand outstripping supply and price going up.
To understand the trajectory of silver today, we need to examine its historical performance during times of economic turbulence. Silver has always been considered a reliable hedge against inflation, particularly during periods of high monetary instability. In the late 1970s and early 1980s, for instance, silver prices experienced a meteoric rise, climbing from just $5 an ounce to nearly $50 in under a decade. This surge coincided with runaway inflation and a collapse of confidence in the U.S. dollar. Fast forward to the 2008 financial crisis, and we saw a similar pattern. As global markets crashed and central banks scrambled to implement unprecedented quantitative easing measures, silver prices soared once again, doubling in value within just 2 years. It was a stark reminder of the metal's safe haven status during times of crisis. What's fascinating is that silver has consistently demonstrated a dual advantage over gold in such scenarios. Its affordability compared to gold makes it accessible to a broader range of investors, while its industrial applications create an additional layer of demand. In other words, silver benefits not only from fear-driven investment, but also from economic recovery efforts that fuel industrial production. Now let's talk about what happens during periods of sustained currency devaluation. History shows us that when confidence in fiat currencies falters, precious metals, particularly silver, become the go-to store of value. As inflation erodes the purchasing power of paper money, silver's tangible, finite nature provides an enduring appeal. Consider the 2010s when silver hit nearly $1.50 per ounce again, fueled by loose monetary policies and fears of prolonged economic stagnation. The parallels to today's economic environment are hard to ignore. We're once again facing persistent inflation, global debt levels that have never been higher, and central banks resorting to unconventional measures to stabilize economies. The setup looks eerily similar. Yet this time around, some analysts argue that silver's potential is even greater. With the rapid rise of green energy technologies and the push for industrial decarbonization, silver's demand dynamics have fundamentally evolved. The historical highs we've seen in the past could soon look like just the tip of the iceberg. By revisiting these pivotal moments, we can start to connect the dots. Silver's history is one of resilience and explosive growth during economic upheavals. And if history is any guide, we could be on the verge of witnessing another seismic shift in its value. But the question remains, how high can it go? And what role will you play in this unfolding story?
Raise revenues by cutting taxes, which makes eminent sense. If you cut prices, retailers do it all the time. Cut prices to get more volume and get. If you cut taxes, you're going to get more activity, and you're going to, as a result of that, get higher tax revenues. So that too many people equate marginal tax rate cuts with cuts in revenue. That's not how it works. Our problem has been our spending, and I think we're going to see him, go after that. So that's not to say he doesn't do other things where he can. He's not a traditional conservative in terms of spending, but I think generally, if they mean the business, it looks like they mean we're going to see a lot of the fat come out of the government, and hopefully he can rein in some of the spending. Now, that being said, as I said before, we're going to have massive monetary and fiscal response to a bust if we get a bust, and that's really not in his control. That's really going to be Congress is going to be doing that. It's going to be a little bit like the pandemic on steroids, where they're going to be faced with a free-falling financial system around the world. And I think you're going to see around the world that response that we got to do big money, which will be the first thing because they can do that quickly. We got to pump money in like crazy, and it'll be matched, I think, in many places by fiscal supports. So you'll see. They'll be bailing out pension funds. They'll be, basically stopping money market funds from going down. They'll be doing a lot of things to try to stimulate and get us back on track. And I view that, again, almost like 2020 in that it's not really part of Trump's policy. It's just going to be a global response.
Let's shift our focus to an emerging trend that's capturing the attention of financial analysts and policymakers alike. The increasing role of gold and silver reserves in state-level economic planning. A prime example is the recent bill introduced in Texas, which proposes that the state hold $4 billion in gold bullion and $1 billion in silver bullion. Why is this significant? It's more than just a hedge against inflation. It's a strategic move to reduce dependency on the Federal Reserve and fiat currency systems. For context, the value of the U.S. dollar has been steadily declining, with its purchasing power dropping nearly 20% since 2020. This isn't just a Texas problem. It's a global concern. Central banks around the world have responded by buying gold at record levels, with 2023 marking the second consecutive year in which they added over 1,000 tons to their reserves. While gold often takes center stage in these discussions, silver is increasingly being viewed as a complementary asset. What makes this push toward precious metal reserves so compelling is its broader implications. Texas isn't alone. States like Tennessee and Utah have also begun integrating gold and silver into their financial strategies. The rationale is clear. By diversifying away from Federal Reserve notes, these states are positioning themselves to better withstand economic shocks, particularly in scenarios where the dollar faces severe devaluation. But there's more to this story. Holding significant reserves in gold and silver doesn't just protect against inflation, it signals a shift in monetary priorities. It challenges the traditional reliance on fiat currency systems and opens the door to alternative monetary frameworks. As Professor William Green of the Mises Institute explains, this could lead to a reverse Gresham's law effect, where good money like gold and silver drives out bad money like unbacked fiat currency. Over time, this could erode the Federal Reserve's monopoly on money, changing the financial landscape as we know it. For investors, this trend is worth paying attention to. As states and institutions begin to stockpile precious metals, they create upward pressure on demand, particularly for silver, which offers not only investment stability but also vital industrial utility. The question is, will this growing demand outpace supply, creating a surge in silver prices? These developments underscore a key point. The role of silver is evolving from being just a hedge for individual investors to becoming a cornerstone of institutional and governmental strategy. This shift could be a game changer, not just for silver prices, but for how we think about wealth preservation in a rapidly changing economic environment. What do you think? Could this state-led movement signal the beginning of a broader monetary revolution? And if so, are you ready to position yourself to benefit from it?
Yeah, I think the melt up really, I don't think his policies get enacted soon enough to impact the melt up. The melt up's baked in the cake, in my opinion. It's not the result of anything he's doing. And even the bust, I don't think is really going to be, most of it is not going to be the result of anything he's doing. I think the argument that he was a big spender is really kind of not that it's your argument. I hear it a lot on the street, or certainly in the media. And it's a bit unfair in that we had a pandemic and it didn't matter who was in that seat. You know, we had to do that to pull ourselves out. We shut down the world economy, for heaven's sakes. And frankly, it was a good thing that between the president and Congress, we acted fast and pulled ourselves back out of that. So we had a terrible quarter, I think second quarter of 2020, but we went back on the recovery trail pretty quickly thereafter, only because of the very aggressive fiscal and monetary response. So I think it's, again, it's politics. That they want to gloss that over and say, well, that was because he's a big spender. He was dealt a set of cards there that nobody could have done any better with. So I kind of walk past his spending and look at basically he has a supply side approach, which is we cut taxes, we're going to raise all boats, we're going to see the growth pick up, and frankly, I think. The economics profession, particularly the Ivy League economists and Wall Street economists, have been wrong for a long time in terms of looking at marginal tax cuts and treating it as if that means we're going to get less revenue. The history shows, in both in the Reagan cuts and in the Trump cuts, that we...
Now, let's get to the heart of David Hunter's bold prediction. Silver soaring to $500. At first glance, this figure might seem outlandish, but when you break down Hunter's reasoning, the logic becomes difficult to ignore. Hunter has consistently warned of what he calls a market melt-up, a parabolic rise in asset prices driven by a combination of monetary policies, investor FOMO, fear of missing out, and the erosion of confidence in fiat currencies. According to him, the melt-up we are currently experiencing is only the precursor to a much larger, more dramatic surge, with silver playing a starring role in the unfolding drama. Why silver? For one, it's vastly undervalued compared to gold. Historically, the gold-to-silver price ratio has hovered around 15:1 in times of monetary stress or economic upheaval. Today it sits closer to 8:1, signaling massive potential for silver to close that gap. Hunter argues that this correction alone could send silver prices skyrocketing. But the story doesn't end there. Hunter points out that inflation, while seemingly under control in some areas, remains a persistent global issue. Central banks may claim victory over inflation in public, but behind closed doors, their actions suggest otherwise. The aggressive accumulation of gold and silver reserves by these institutions signals their anticipation of ongoing currency devaluation, and Hunter believes this trend will only accelerate as faith in the U.S. dollar continues to wane. Then there's the industrial demand factor. Silver is indispensable in industries like renewable energy, electronics, and healthcare, and demand from these sectors is projected to grow exponentially over the coming decades. With supply chains still recovering from disruptions and silver mining facing increased regulatory hurdles, Hunter sees a supply crunch on the horizon, a perfect storm for a price surge. What really sets Hunter's prediction apart, however, is his timeline. He's not talking about silver reaching $500 in the distant future. He believes it could happen within the next economic cycle, possibly as soon as the next few years. This urgency stems from what he describes as the bubble dynamics of the current market. As stocks, bonds, and other assets inflate to unsustainable levels, the inevitable correction could send shockwaves to the financial system, catapulting silver to unprecedented highs as investors rush to preserve wealth. Hunter's analysis forces us to confront a critical question. Are we prepared for such a dramatic shift? With the Federal Reserve's policies fueling uncertainty, inflation lingering in the background, and geopolitical tensions escalating, the conditions for silver's breakout appear to be aligning perfectly. The $500 mark may seem shocking now, but history has shown us time and again that the market can defy expectations when fear and opportunity collide. So what do you think? Is Hunter right? And are we on the cusp of witnessing one of the most explosive rallies in silver's history? If so, how are you planning to capitalize on this opportunity?
You're right. It's basically a 42-year secular bull market. It started in August of 1982. I think we're in the final stages of that. And I think, as I've said, it's pretty much baked in the cake that we're going to have a melt up and I believe a bust following that melt up, or a big bear market and a global bust. But Trump's policies are dramatically different and dramatically, I think, helpful to the economy longer term in terms of basically moving us back towards a capitalistic approach to things, less government. Definitely trying to, take the fat out of the government, less regulation, definitely going to see, I think, some pretty aggressive deregulating. And all of that gives me some hope that on the other side of the bust, we could see a very strong recovery cycle, and it might head off some things. We might, particularly with AI, we might see productivity improve enough that we can hold back the inflation. My whole scenario is that a global bust, which is the result of decades of overspending and decades of overborrowing and, very much massive leverage on the system, combined with a policy error on the part of the central banks of over-tightening because they're so worried about inflation, that we can get a real crack up in the economy and in the stock market, leading to a response from the central banks of massive money, bigger than anything we've seen. So bigger than the 2008-9, certainly, bigger than the $5 trillion that the Fed had to do in 2020, 21. This time, I think you could see as much as $20 trillion out of the Fed in QE and new money in a response trying to stop a free-falling financial system. It's that money that can jumpstart the next recovery, but also jumpstart an inflation cycle that will go way beyond what we saw this cycle, and even much higher than what we saw in the early 80s. What I'm saying here is that maybe there's a fighting chance that Trump's policies might at least soften that and allow the cycle to extend beyond what I see. But at least right now, I think the macro trumps Trump. The macro is much bigger factor than even his policies. So although I'm very supportive of what he's trying to do, and I think it's gives us a fighting chance, we've been doing this so badly for so many decades. Even his aggressive policies may not be enough.
One of the most telling signs of silver's potential breakout lies in the behavior of central banks worldwide. Over the past 2 years, central banks have been buying precious metals at a pace not seen in decades. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2023 alone, marking the second consecutive year of record-breaking acquisitions. While gold often grabs the headlines, silver is quietly becoming an integral part of these strategic reserves. Why are central banks making this move? The answer lies in a fundamental shift in global monetary policies. The U.S. dollar, long considered the bedrock of global finance, is facing growing skepticism. Mounting debt levels, persistent inflation, and geopolitical tensions have eroded confidence in the greenback. As a result, central banks are hedging their bets, diversifying their reserves with precious metals that can hold value during economic instability. Silver, often referred to as the poor man's gold, is emerging as a key player in this shift. Unlike gold, which is primarily a financial asset, silver has extensive industrial applications. This dual demand profile makes it uniquely positioned to benefit from both defensive strategies by central banks and the accelerating push toward green energy and technology. Take China, for example. While much attention is given to its gold reserves, the country is also a significant importer of silver, driven by its industrial needs and monetary strategy. Similarly, Russia has been ramping up its purchases of both gold and silver as part of its broader de-dollarization efforts. These moves aren't just about hedging against inflation. They're about preparing for a world where the U.S. dollar's dominance may no longer be guaranteed. This trend isn't limited to nation-states. Major institutions and private investors are also following suit, reallocating capital into silver-backed assets as a hedge against currency devaluation. The result? A tightening of supply and increasing demand that puts upward pressure on silver prices. For individual investors, this presents a unique opportunity. As central banks and institutions continue to build their precious metal reserves, they create a ripple effect that amplifies silver's scarcity and value. The question is, will retail investors recognize this trend in time to benefit? Think about it. If central banks, with their unparalleled access to financial data and economic insights, are betting on silver, what does that tell us about its future? Could this be the beginning of a broader realignment in global finance, with silver playing a pivotal role? This central bank-led shift is more than just a market trend. It's a signal of systemic change. And if silver is becoming a cornerstone of monetary strategy at the highest levels, perhaps it's time for all of us to take notice and act accordingly.
Runs. And so, if that's the case, understand that, yes, a few months isn't very far away, but 25 or 30% is a lot of money to leave on the table. It's usually, let's say the Russell, which is almost 40% from here, that's basically 2 or 3 years worth of returns, even if it can come in a few months. So that's first, is kind of know yourself and figure that out for yourself, how you'll behave if that's what happens. And then the other big thing is this whole buy and hold attitude of we've had for probably 30 years, from the mid 80s. The mantra for most of the financial advisors is You can't time the market. Nobody's smart enough to time the market. So it's time in the market. It's buy and hold. And that's worked great. If you just put your money in an index fund 30 years ago, you're sitting pretty. You made a lot of money. The problem is the environment going forward is going to be the opposite kind of environment. Instead of rates coming down for 30 years, rates were 40 years, rates were 15% on the 10-year back in the early 80s, and they got down to 0.4% in 2020. We have one more run where I think you can get to zero, so maybe even a new lower low on rates. But once that happens, we begin a big bear market in bonds, and rates will be going from that zero level on the 10-year, where by early next decade, I think they'll be close to 20%. That's damaging to index funds because index funds depend on PE multiples expanding. The reason you did so well the last 3 or 4 decades is because PE multiples were expanding because rates were coming down. When rates are going up, PE multiples will shrink, and you'll go back from 25 times earnings to single digits. And it'll be very hard to overcome that shrinkage in PE multiples.
The U.S. dollar has been the linchpin of the global financial system for decades, but cracks in its dominance are becoming increasingly visible. As inflation eats away at its purchasing power, and foreign nations seek alternatives to dollar-based trade, the question arises, is the dollar in decline? And what does that mean for silver? First, let's examine the root causes of the dollar's weakening position. Since 2020, the dollar has lost nearly 20% its purchasing power due to inflation. This devaluation is not just a domestic issue. It has global ramifications. Nations that hold reserves in U.S. dollars are growing wary of its reliability as a store of value, and many are diversifying into other assets, including gold and silver. Central banks are leading this shift, but they're not alone. Geopolitical tensions have further accelerated the move away from the dollar. Countries like Russia and China are actively working to reduce their dependence on the greenback, promoting bilateral trade agreements in local currencies and stockpiling precious metals. This de-dollarization trend is a direct response to concerns about the stability of the U.S. economy and its fiscal policies. For silver, this presents a unique opportunity. Historically, when the dollar weakens, silver prices tend to rise. Why? Because silver is priced in dollars, and as the currency loses value, it takes more dollars to purchase the same amount of silver. This inverse relationship is a critical factor that many investors overlook. But the implications go deeper. A declining dollar undermines confidence in fiat currencies overall, driving more investors toward tangible assets like silver. Unlike paper money, silver cannot be printed at will, making it a reliable store of value in uncertain times. This dynamic was evident during the 1970s and the 2010s, when significant declines in the dollar's value coincided with major surges in silver prices. Today, the stage is set for a similar scenario. The Federal Reserve's recent monetary policies, including rate cuts and quantitative easing, are designed to prop up the economy, but have the unintended consequence of weakening the dollar further. Meanwhile, rising geopolitical tensions, coupled with trade wars and sanctions, are eroding trust in the U.S. financial system. For individual investors, this is both a warning and an opportunity. The weakening dollar signals a need to diversify away from fiat currencies, and silver stands out as an accessible, versatile, and historically proven hedge. The question is, will investors act before the next wave of devaluation hits? As we continue to see the dollar's dominance being questioned, it's worth asking, could this trend mark the beginning of the end for the dollar as the world's reserve currency? And if so, what role will silver play in the next era of global finance?
Yeah, exactly. I would say, first of all, and I understand, like I said, from a long-term standpoint, we're close, but close in time, and yet still 25 to 40% upside from here. So my first thing I tell people is you have to understand yourself. And, you might say, because I've heard lots of people say, I don't want to risk, going down the other side of the mountain. So I'm going to get out early. I'm not smart enough to pick the top. And I get that. But just know that if you get out now, the typical investor is going to be compelled to be back in before this thing rolls over. Because if you have a run where you're up 25, 30, or 40% in a matter of a few months, that's going to be psychologically very compelling, because that's how psychology works on investors. Is if it's up, they're bullish. If it's down, they're bearish. And if it's up a lot, they're going to be very bullish. So you can say, I'm big picture, I'm going to get out now. And then if you miss 25, 30, or 40%, this story at the top is going to be compelling, or you wouldn't be there. The story's going to be, I can pretty much predict the story's going to be, the Fed's got a lot of room to ease. Things have slowed down. Inflation's rolling over. The cycle looks like it has several years to run. This is not the time to get out. That will be what will be at the top. So understand, it's not going to be, there's no bell that goes off. There's nothing, you're not going to be sitting there 25% higher saying, oh, I'm glad I got out. You're going to say, I got out and this looks like I could have another 50%. So know yourself. If you have that discipline to say, I'm not worried if I miss a lot, I'm, like you say, it's the end of 40 years. If I miss a year of it, big deal. If I miss 6 months of it, big deal. If you're like that, then maybe you can get out and rest easy. But for most people, that is going to make a difference when it.
The geopolitical landscape today is more volatile than it has been in decades, and these uncertainties are creating significant ripple effects across global financial markets. For silver, these dynamics could serve as powerful catalysts, pushing its price toward unprecedented levels. Let's start with the ongoing geopolitical tensions. The war in Ukraine has disrupted global supply chains and driven up the cost of energy and raw materials. Meanwhile, escalating conflicts in the Middle East threaten to destabilize key oil-producing regions, further straining global economic stability. These crises are forcing nations and investors to reconsider their reliance on traditional financial instruments and seek safer alternatives, including silver. On the economic front, trade wars and protectionist policies are intensifying. The U.S.-China trade conflict, for instance, has not only strained bilateral relations but also led to a decoupling of their economic dependencies. As global trade becomes increasingly fragmented, nations are moving to diversify their reserves, shifting away from the dollar and into tangible assets like gold and silver. Then there's the political instability within major economies. The U.S. faces a polarized political environment with significant implications for fiscal and monetary policies. Recent discussions around government shutdowns, debt ceilings, and fiscal irresponsibility have further eroded confidence in the dollar, amplifying the appeal of precious metals as a hedge against uncertainty. Add to this the global push for de-dollarization. Russia, China, and other emerging powers are actively promoting trade in alternative currencies and building reserves in precious metals to reduce their dependence on the U.S. financial system. These moves are not just strategic, they reflect a growing lack of trust in the dollar's long-term viability. For silver, these geopolitical and economic triggers create a perfect storm. Silver's dual role as an industrial metal and a store of value uniquely positions it to benefit from both the defensive strategies of investors and the increasing demand for industrial applications driven by global growth and green energy initiatives. What's even more compelling is the speed at which these triggers can escalate. A sudden escalation in geopolitical conflict, a major financial crisis, or a collapse in confidence in fiat currencies could ignite a massive rally in silver prices. Investors who are positioned early could see significant gains, while those who hesitate might find themselves priced out. So here's the big question. Are we approaching the tipping point? If we are, what steps should you take now to ensure you're prepared for the financial implications of these global shifts? Let us know your thoughts in the comments below. This is a conversation we all need to have.
As I say to people, the bust is really what ends this, right? Or the market will begin discounting a bust. we haven't had a bust in the post-World War II era. So over 80 years. I mean, you could call the Great Depression a bust, I guess. Certainly was, of that magnitude. But we haven't had anything since then to rival what I'm calling for. So it's not a timing call at all. That, a bust will happen when it happens, but we're moving towards it and getting closer. The melt up itself, I always push it out 3 to 6 months just because it's, you've got, as I said, 25 to 40% upside from here, depending on the index. That's not going to happen in a week or 2 or 3 or 4. So even though I think it's going to be very steep, I assume it'll take a few months. So there's no magic to any timing. I just, as long as the melt up, all the analysis points to the melt up having more runway, I'm going to keep stretching it out. As I say, the markets are in charge of that. It's people are so conditioned to trading calls where they want to know, what day, what week, what month is the market going to peak, and that's just not realistic when you're talking about a big cycle market. It'll peak when it peaks, but I think we're getting very close. Time-wise, we're close. Time, if it's a 42-year secular bull market top and it's 3 or 4 months away, that's close. If it were a 1-year call, 3 or 4 months is widespread. But it's the end of something that's been going on for over 4 decades.
Another crucial factor driving silver's potential surge lies in the ongoing constraints on its supply. While demand for silver continues to climb, fueled by industrial applications and investor interest, the supply side of the equation is struggling to keep pace, and that's where things get interesting. Silver mining, which accounts for the bulk of new supply, has faced numerous challenges over the past decade. Major producers like Mexico and Peru, which together account for nearly a third of global output, have experienced declining production due to stricter environmental regulations, resource depletion, and labor disputes. In fact, global silver mine production has been relatively flat, even as demand has steadily increased. This imbalance sets the stage for a potential supply squeeze. Recycling, which serves as a secondary source of silver, is not filling the gap as quickly as some might expect. Although silver recycling from industrial and consumer products has grown marginally, it remains constrained by logistical challenges and the sheer complexity of extracting silver from electronic waste, catalysts, and other materials. The process is expensive, time-consuming, and often not economically viable unless silver prices rise significantly. Another layer of complexity comes from silver's classification in mining operations. A substantial portion of silver is produced as a byproduct of other mining activities such as copper and lead-zinc extraction. This means that the supply of silver is indirectly tied to the demand for these base metals, which can fluctuate based on broader economic cycles. If base metal mining slows, silver production could decline even further, tightening an already constrained market. Meanwhile, demand for silver is showing no signs of slowing. Industrial applications are expected to grow dramatically as the world transitions to greener technologies. Solar panels, for instance, rely heavily on silver for their photovoltaic cells, and with global commitments to renewable energy accelerating, the demand from this sector alone could overwhelm current supply levels. Add to this the increasing use of silver in electric vehicles, medical technologies, and electronics, and you have a recipe for a sustained demand surge. For investors, these supply constraints combined with rising demand present a unique opportunity. If the market reaches a tipping point where demand far outpaces available supply, silver prices could climb rapidly as scarcity takes hold. This is the kind of setup that historically leads to explosive price movements, and all signs point to silver being on the brink of such a scenario. But what does this mean for you? Are we heading into a silver shortage that could redefine the market? And if so, how will you position yourself to take advantage of these shifting dynamics? Let's discuss. Leave your thoughts in the comments below.
So in the shorter term, meaning the next 6 months, I'm a huge metals bull. So I think Gold's on his way to 3,400. That's my new target. I raised it from 3,000 a short while ago. And silver, I have a target of 75. So it's a long way away, but I think that's what we're going to see in the next several months. I think we've had this pullback here, this correction of late that is running its course, and I think we will see both of them move to new highs for this year and then keep going. And that will be driven partially by the dollar. The dollar looks like it's rolling over. I think it's going to roll over hard. I've got an 82 target on DXY. As I said, it's currently just under 107. So, or maybe it may be down towards 106. And so that's a big drop from here. So the dollar will help the metals. Interest rates, I think, are going to fall, as I said before, pretty hard. So that'll help the metals. And then the whole idea that the Fed has begun a long easing cycle will also be a wind at their back. So I think you get this run, and then ultimately the bust interrupts that. So you have a big correction after that big run. Silver might come all the way back down here. Gold might go from 3,400 back to the mid twos or even back to 2,100. So you'll have a good size correction and another re-entry point there. And then the real story is the post-bust period, where I see gold going to 20,000 by early next decade, silver to 500, copper will be through the roof. I think copper can get up to $6 pre-bust, meaning the next several months. So it's down in the low fours now. I think you can see price copper up to $6. And, and then after the bust, copper might fall all the way to $1 because it's so cyclical in the bust. And then after the bust, it, easily could go, who knows, $20 might be possible.
Now that we've explored the forces driving silver's potential surge, let's turn the conversation over to you. With everything we've covered, from central banks stockpiling precious metals to the weakening U.S. dollar and the looming supply constraints, it's clear that the silver market is at a pivotal moment. So here's the big question. Where do you stand on silver's future? Do you agree with David Hunter's bold prediction of $500 silver, or do you think the market is too optimistic? What factors do you think could accelerate or possibly derail this trajectory? We'd love to hear your thoughts. Share your predictions, insights, or questions in the comments below. You planning to invest in silver, or are you taking a wait-and-see approach? What's your strategy for navigating these volatile economic times? Also, don't forget to subscribe to the channel if you found this discussion valuable. By subscribing, you'll stay updated on the latest insights, predictions, and strategies that could make all the difference in your financial journey. The future of silver is shaping up to be one of the most exciting and unpredictable stories in the markets today. The more perspectives we have in the conversation, the better prepared we'll all be to understand and act on these unfolding opportunities. Let's keep the dialogue going.
Even if you're in an index where earnings are doing okay. So it'll be the complete opposite environment. And then it's a stock picking environment where index isn't the name of the game. It's more what types of stocks will do well in inflation, what types of stocks will do in an industrial recovery. And then it's commodities, it's caterpillars of the world, big heavy industry, et cetera. There'll be other things too, but it'll be a very different leadership and a very different kind of approach to investing. Bonds won't do well, so 60-40. Bonds in an environment where the interest rates are going sky high, bonds will get hit hard. So 60-40 doesn't do you very well. What will do well, you can have 60-40, but that 40 in bonds, instead of being in 5, 10, 15, 20-year bonds, you'll be best to be in treasury bills and rolling them every 6 months at higher rates. That way you're refreshing the rate as the rates go up. So it will take a different mindset. And I can promise you right now that most financial advisors aren't going to be there at the beginning. They're going to be looking at what worked before. It will, over time, that's what people will gravitate to. But if you want to be ahead of the curve and benefit when things change, you're going to have to think ahead and understand it's a different environment. And then ultimately, it's, in the bust, which is before the next cycle, in that bust between this cycle and next cycle, you could have an 80% bear market. And so, again, it will behoove you to not be a buy and holder, but say, I've done well. I want to take something off the table and prepare for the next opportunity.
Now, it's time to bring all the pieces together and fully unpack David Hunter's bold claim of $500 silver. How could we realistically reach such an unprecedented milestone? The answer lies in the convergence of everything we've discussed. First, the weakening U.S. dollar sets the stage. As global trust in fiat currencies erodes, both retail and institutional investors are seeking alternatives that preserve value. Gold often takes the spotlight, but silver, with its lower price point and dual utility in industry and investment, offers an unparalleled upside. Next, the central bank's aggressive accumulation of precious metals is a clear signal. When the institutions with the most insight into global economic trends are betting big on gold and silver, it's a move worth paying attention to. As these purchases intensify, they create a cascade effect, driving up prices and sparking broader market interest. On the industrial side, silver's indispensability in green energy technologies and electronics guarantees its demand will continue to grow. With supply chains still recovering and mining output lagging, the market could face a significant supply crunch. This imbalance alone could send silver prices soaring. But the real game changer lies in the psychology of the market. Hunter has emphasized the concept of a parabolic move driven by fear of missing out and capital rushing into hard assets. In such a scenario, technical resistance levels break down, and prices surge as market sentiment shifts from cautious optimism to outright euphoria. If this happens, silver's historical highs could be shattered, paving the way to Hunter's $500 target. Let's not forget history. We've seen silver make dramatic moves in the past, doubling, tripling, or more, during periods of economic instability and monetary upheaval. The conditions we're seeing now are eerily similar, but this time the stakes are even higher, with silver playing a pivotal role in future technologies and monetary strategies. The potential upside could be greater than ever before. So, what does this mean for you? If silver hits $500, the implications for wealth preservation and growth are massive. But acting early is key. As David Hunter has warned, the window of opportunity may be closing faster than we think. If you haven't already, subscribe to the channel for more in-depth analyses like this one. And remember, this is not financial advice. Always do your own research and consult a professional before making investment decisions. The silver market is primed for a revolution. The only question now is, will you be ready when it happens?